Hi, team. Uwe Jacobs, property strategist from Property Friends. Welcome, welcome, welcome. Well, it's time for another monthly update, the update for the month of September. I will include some notes and commentary on the RBA update as well, what they did with the reference rate. Okay, the property market is still quite buoyant, as evidenced by last week's CoreLogic reports. I've plucked some figures out of that. Sydney's property prices increased 0.2% over the last week and increased 0.9% over the last month and are 7.2% up year to date. That is still 0.7% higher than they were 12 months ago, which was close to the peak. Melbourne, same data. Property prices increased by 0.1% over the last week, increased by 0.5% over the last month, and are up 1.6% year to date, which is still 2.5% lower than they were 12 months ago. Brisbane increased 0.3% over the last week, increased 1.4% over the last month, and are up 4.1% year to date, which means that they're still down 3.6% from 12 months ago. Overall, Australian capital dwelling prices increased by 0.9% over the last month and are now only 0.3% lower than 1 year ago. Again, it is very, very clear and very, very obvious out there. The ripple effects are going out from the capital cities, and the large regional cities are doing a lot better. The rental yields are definitely much higher, and the capital growth has been delayed, which is the ripple effects, which is coming to the fore now in the regional cities. That's why, from a strategic point of view, it's much better, no question, to invest into large regional centers. The monthly inflation figure has come in at 4.9% in July, lower than the 5.4% expected for the month of June, according to the latest ABS figures. And this gets me to the RBA cash rate. We were at 4.1%. The RBA experts, so-called experts, 86% of them forecasted a 0%, so no change. And this is exactly what happened, no change. I think we are pretty much done with the increases for the next few months. I find it interesting, that sentiment that we're done with the increases can also be maybe interpreted from the fact that the RBA itself is now saying this is the likelihood of change, and that's the decrease. They're no longer talking about increase, they're talking about decrease. So in the rate target tracker. Very, very interesting. Factors that will affect the property markets in the upcoming months is, of course, the level of interest rates. Generally speaking, as I have mentioned, I think we will be okay and will not have any increases for the next few months. The suggestion is by the beginning of next year, rates will go down again once we've got the inflation, which is, of course, another major factor under control. The strength of the economy will be a major player in the interest rates. And I'll be very interested to see the government's policies on housing. It is important to monitor and check on these factors, and also focus on properties with strong rental demand and limited supply wherever you want to buy. I suggest to consider properties that offer good capital growth potential, such as those in growth areas with strong economic growth and population growth, but also at the same time good rental yield. It is the combination of that allows you to build a portfolio and moreover to hold a portfolio in times where interest rates have gone up. It's no rocket science that rental has gone up strongly as well. So if you've bought in an area where the rental yield is good, you should be pretty much okay. Okay, that was the monthly update. If you've got any questions, don't hesitate to put them in the comment section. And otherwise, we are happy to help. And remember, you got to be in it to win it. Have a good one.